lot of times 7-Eleven, to acquire more real estate and build their portfolio, they'll buy a bunch of older stores from like other gas station owners and then convert them over to 7-Elevens. But the sneaky thing is that some buyers don't notice is that they carry over the old lease and then kind of like, kind of update it a little bit. So if a buyer comes in and don't read maybe like 20, 30 years worth of lease amendments and all that stuff, that they can find that they may be responsible for tenant improvements, or they may have to do something to get the compliance with the state. It's just like, so it's really just making sure that you know what you're getting into.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig, and with me, as always, is John Cohen. How's it going, bud?
We're doing good. We are approaching the end of Q2, halfway through the year. And I've got like remotivated. I'm out of surgery. It's in the past. I have my checkup next week. And I'm excited to get back at it, get back to that weight loss goal, get back all that stuff. So I've been looking forward to this point, to getting back at it. I luckily had a really good first quarter, so I was able to slack off a little bit. But we have to get back on the horse. But we're excited. We healed a lot faster than I was supposed to, and it wasn't nearly as bad as I expected.
just built different, apparently.
There you go.
Healing quick. Can't complain, but that's good. Glad to hear you're bouncing back. I'm glad to hear you're getting back on that. I've basically not paid any attention to the weight loss stuff Q2, but haven't put on a ton of weight, so that's been good. But definitely want to start back up again with that. So got to figure out a way to start incorporating it better, because the end of the 75 hard, I was like going to do my workouts at like 10 o'clock at night, and that's just not sustainable, obviously. So
10 o'clock at night. Yeah, that's tough, man.
Yeah, exactly. So, I wish I was a morning person. Wish I could just hop up at 5 and get a workout in and do it, but it's just always been a struggle. So I don't know. We'll see what happens. But let's jump into today's episode. We got a great guest on today. He's got his own podcast. I think we've both been on it. Not really sure. I think I've been on it. I don't know about you, John, but really excited to have him on and, share his story, talk, learn from him, all that great stuff. So with that being said, Dwaine, thank you so much for joining us.
Yeah, I really appreciate it, fellas. And guys talking about the workout and stuff. I just restarted my routine. I'm up at 3:50 a.m. and I hit the gym here at my local LA Fitness at 5. So I've been doing that, because like I said, I got the 2 young kids just like John, and you got to get everything in before the inmates come in and cause a ruck. So for my kids, they're up at like 6, 7 o'clock, and it changes randomly. So I try my best, but that it works for me.
Jeez. Well, more power to you, bud. But for anybody that doesn't know who you are, kick us off. Tell everybody a little bit about you, your background, what you do, all that good stuff.
Absolutely. So I'm pretty much known for net lease brokerage and investments. So I've been doing that for over 8 years. I got a brokerage called GCT Net Lease. We focus on single tenant, triple net lease properties. I'm primarily working with a lot of exchange buyers, high net worth investors that are looking for, essential businesses with good tenants and with long-term leases, guaranteed rent for, especially times that we just went through, COVID, hopefully at the tail end of the pandemic. We've been extremely busy with sales, dealing with a lot of investment properties that people just want cash flow and certainty. There's just a lot of fluctuations in the market. I got into the business through my mentor, who was one of my first clients as a real estate agent. And I discovered that he owned a Walgreens pharmacy. I had no idea that you can actually own one of these things. So he owned a Walgreens pharmacy, along with other things, own apartments and self-storage facilities. But I was really intrigued by that. And I was asking him, I didn't know that, because I thought that Walgreens owned and operated their own building. But apparently you can be the landlord, and Walgreens, a big name brand name tenant like that, of that caliber, can actually be one of your tenants. So that's how I got into the business. And then I actually just learned everything about it. Work with a lot of buyers and, and sellers as well. But really just kind of dug deep into it. And I'm also a passive investor in a lot of net lease investments as well. And it kind of, one thing that was really attractive to me is that it afforded him the lifestyle, like, you and John know, of this kind of this, you get to control your own schedule, you have kids, family, things that you want to do, and owning these types of investments, especially on a absolute triple net lease basis, allows you to pretty much do it. They call it mailbox money. So that's one of the big things that people are attracted to this type of investment niche.
Yeah, it's pretty funny. It becomes almost second nature, but you forget that like moment of realization that, all these stores and all these retail spaces are like owned by somebody else. And you kind of never think about it until you actually get introduced to it. Like I used to never think, up in New York, all the retail strips, all like the tiny little ones, I never thought about like who actually owns them. It's just like probably some random guy that lives, 5-10 minutes away, maybe 30 minutes away, because they're so small, just has owned it for forever. And you would never think about it, but it's pretty crazy. Once you get into the triple net is probably very similar, because these things aren't, a lot of them aren't massive building. Walgreens are pretty big, but you talk about, a lot of your fast food ones, they're not massive buildings where it's probably just, some guy or girl or family that you probably would just pass on the street and never think twice about. It's pretty crazy when you kind of step back and think about it.
Exactly. I mean, these are places that we eat, shop, bank, and do our stuff every single day. It's a part of our daily lives, and it never just come to think about it. We know like the rental property down the street, or the little small office strip or something like that. That's something we associate because it's more sexier, more popular type of investments. But yeah, people don't even think about it. But like I said, recently we've just been slammed with about of interest that are in this asset as it's starting to become more popular. Like I said, some of the stuff that are really popular, like the fast food, especially during the pandemic, people got to eat. People need diapers. They need, toilet paper, Dollar Generals. They need their prescriptions. They need food. They need something. So it's like these businesses been around, and now that it's, people been looking around, seeing what's the best options for me, and that's why things has been becoming more attractive for this particular asset class.
Mm-hmm. So you've seen a big shift into essential services, basically, is what you're saying.
Exactly. So
And
that's, if you stick with that, and the same thing with housing, people need a place to live, same thing with, food and essential items and needs and things like that.
so have you had any clients that are selling out of non-essential triple net spaces into essential? And have you had it run into any difficulty selling those non-essential types of triple net deals?
I haven't come across much. A lot of my clients, I've been very fortunate to have a good, portfolio of clients that come in that we've been focusing on that from the beginning. Like I have a couple clients that we got into some regional, like sit down restaurants. There has been a little bit disruption because you have a place where the kitchen is, the dining area has been closed, due to COVID. And then, of course, they had a little bit pick back up as people slowly start getting into it. And that's like a state by state basis. So I'm seeing some things there. And of course, the things that were like the larger scale tenants, we was working on a Best Buy retail deal. And of course, Best Buy is being challenged by Amazon and all those different type of, e-commerce stores. So those have some difficulty selling those assets. But for the most part, the clients that I'm dealing with, because I'm constantly educating them, is to stick with essential tenants, stick with stuff that won't be disrupted by e-commerce, and something that's continuously being needed, and a strong tenant that just has a long and great track record for success.
And
Have
are
you
you seeing any?
seen?
Oh, go ahead.
No, before.
So are you seeing any sort of trend in terms of like the people that are coming in and like buying these? Is it a lot of like high net worth professionals? Is it more like retirees, or has it just kind of been the same as what you've always seen?
It's been both. I have a large class of investors that have been larger because, based off their portfolio, a lot of them own other stuff or they own other businesses. So triple net leases is kind of like a good complement. Of course, you're not going to get the type of returns like apartment buildings, sort of where you can be able to force appreciation. If you have a 15-year lease with a Dollar General, where the the rental increases in either in year 11 or the rental options, you're just getting flat rent pretty much. I mean, you know what you're going to get compared to other assets where you can kind of increase the rent based off how the market is, and you can decrease your expenses and things like that. So it kind of fits well for people that are maybe older in age and they're kind of heading for retirement. But a lot of my recently, I'm getting a lot more calls from kind of younger people who just want to just have a very well diverse portfolio. So they run a business, they maybe own a coffee shop or some other business, and they say, hey, I want to go add in an O'Reilly's Auto Parts or Dollar General, or the deal that we're working on now is 7-Eleven and Chick-fil-A. So it's just like I said, it depends on your investment strategy, but you just want to be able to see if it fits, because cap rates and return on investment is a little bit different from the other typical investments like rental properties, other things like that as well.
I was going to say, from the standpoint of what we just went through, the essential businesses were, probably flourished, right? I mean, now buying and selling those have changed. The stuff that was a little bit more challenging, or did you see when you were underwriting deals, or when you were bringing deals to market, when you were talking to buyers, what or how did they value potential delinquency, or the ability of the landlord not to bring in, or the business not to bring in income? How are people looking at that today in today's world, whether they want to add, maybe not a fast food or a bank or an essential business, but one of these other ones, how they look at that stuff, and how are they looking at that going forward as okay, if I add this, I want to be compensated, but what are you seeing as fair in that regards?
You mean as far as like how they evaluate on a risk perspective, or?
Yeah.
I mean, yeah, it's with the same for it was before, because right now we had like a Starbucks deal that we was working on, and surprisingly, as big as Starbucks is, they're an S&P A- credit tenant. They still ask for rent deferment during the pandemic, and you would think a tenant like that, it's essential businesses. People are still getting coffee, still getting stuff, and they're multi-billion-dollar company. They still ask for it. Panera Bread still asks for it. So many of the companies, they still took advantage of that. And then also we had a couple of my clients, we had to look carefully at some of their existing leases to see if there's any languages that allow them to kind of slip out or defer any rent. So at the end of the day, we still looked at it from a real estate play. Was it in a sound market? South Carolina, North Carolina, out of the the top growing markets, where once they get over the hiccup, that they'll be able to recover. And we look at it from a plan B perspective. If this tenant leaves, would we be able to slip in another tenant to be able to recoup that rent or better? We was looking at recently a Burger King deal. The tenant's been there for a long time. They had a flat rent. And me and my client was just, because he was very hesitant because it's his first deal. But we said, we looked at it, it was in Indiana. We said, look, it's a strong area, has schools here, it has a hospital here, has a lot of the built-in customer base, as well as, I guess, strong street traffic. Plus, it was a really large building, like 4,000 square feet over an acre and a half of land. I said, worst case scenario, if you leave, we can slip in another tenant of this caliber to basically meet this rent. So yeah, we look at, of course, I would say a pandemic would be one of the worst scenarios you can think of. And then now we learned a lot of data from there, but we also got to look at it still from the same way that you guys will evaluate, apartment deal, is the real estate fundamentals there, that, worst case scenario, that if we do have, rent deferment for a couple months, or the tenant just goes bankrupt and leave, can we do something with the building? Because I mean, you are dealing with just one tenant. So those are the factors that we always look at. And then speaking with a lot of the lenders, they early on was very cautious as underwriting deals as well. They required more down and things like that. But their big thing that we was talking to them was about the real estate. They're looking at it from a secondary play as well, because everything was just kind of up in the air at that point. But yeah, just really just coming down to just picking strong tenants. A lot of the deals that we focus on were investment grade, so they were rated by S&P and Moody's. If they were corporate or a large franchisee, we'd make sure that we look at their real estate fundamentals, that they have really strong financial spreadsheets to make sure that they'll be able to just understand and be able to overcome the hiccups of what we just went through. So yeah, it's very tough to kind of predict, but yeah, we just did our best in evaluating both the real estate and the plan B to see if we can be able to survive, regardless of whatever happens.
So how important
That's
is,
interesting. 'Cause I think
go ahead.
no, you go jump in.
I was going to say, so how important is the actual lease that is used? Because I guess in my head, I would just assume they were kind of like boiler and template of like, hey, triple net lease, this company has their lease that they use for everything. Is that the case, or does it vary by location?
Yeah, well, each tenant has kind of like a unique lease. Like I've seen 7-Eleven, O'Reilly's. I mean, because you have majority of the stuff I deal with are absolute triple nets, where the tenant's responsible for the taxes, insurance, utilities, maintenance, the
Hmm.
repairs of the property. But then you have like an O'Reilly's Auto Parts, which is a very good tenant. They operate on a double net lease where the owner is responsible for the roof and structure and parking lot. And then, but some of them also have some different nuances, right? Like you have to take care of the light, or some, or the HVAC. Dollar Generals a little bit differently, so you have to kind of look at them per lease. But overall, each tenant has kind of their, boilerplate set of stuff that they ask the landlord to be covered for. But most of the stuff I deal with are absolute, where a tenant kind of takes care of the bills, which that's why most people like that they'll, it's kind of like a hands off type of
Hmm.
deal. But yeah, there's really no kind of boilerplate, but you have to kind of look at each lease individual just to make sure that you know exactly what you're getting. We get a lot of, I review hundreds of packages each day, and just looking at different leases and things like that, just to make sure that when we're going into contract, into due diligence, especially if I'm dealing with exchange client, we're dealing with a very concise time frame. We want to make sure that we know what we're getting into when we make that offer and get into negotiation.
Hmm. And the reason I ask is because you brought up something about, a Starbucks or, a $1 billion company potentially having room to get out of a lease. I never thought of this, but it makes me almost fear of like, okay, if I'm just a, landlord that owns a couple $1 million building, how does a landlord even feel comfortable that they're not just going to get pummeled by a multi-billion-dollar legal department to just give up a lease or something else when they've got, this massive backing, they've got legal, they can afford to tie up in court forever. And, you as a one-off with one building, especially if you're an older person looking to retire, looking for that quote unquote mailbox money, like how do people have comfort with this, knowing that their tenant is so much larger and has so much more resources? Or does that just never really come up?
It only during this pandemic we really been kind of talking about it. I forget the specific wording, but it's basically, God has done something where it's like kind of out of everyone's control,
Force
like
majeure.
a pandemic. Yeah, the force majeure. So those are the type of stuff, and we're seeing now even the newer leases that are construction, they're also trying to negotiate with developers to get that in there. But a lot of developers that I've been dealing with, they've been able to kind of get that original language where it's been stripped away.
Mm-hmm.
Because for like example, like a Starbucks or a 7-Eleven, which has the financial backing to have the store be closed for a couple weeks or a couple months and still be able to survive, as compared to like a mom and pop store where they lose a month or two, they're done.
Mm-hmm.
So like, yeah, so the developers been, that I've been dealing with, been pretty tough on trying to kick that out while they still try to sneak it in. I mean, any corporation, any business will try to get away with whatever they can get away with. But yeah, we dealt with one of our regional tenants. It was like a kind of like what we have up north, like an Olive Garden. It's called Oregano's, and they're kind of like the Olive Garden of like the Arizona of the area. And they had also a little language of the force majeure, and but nobody would ever think that it would ever pass. As far as, we just went through a pandemic, like nobody thought, like it just came out of the blue, and we just had to deal with it. Good thing with these local states, they was able to get the PPP, supply this to the aid and all that stuff, and kind of keep it going. So instead, we was able to just get rent paid, I think, a couple weeks later, and then they end up adding some more lease term at the end of the term. So end up working out, and my client at the time was very good with it. But of course, like I said, it's very hard to predict, but this the thing I have a lot of discussion with developers is this when they're negotiating with these bigger tenants to make sure they hold firm to make sure that they don't sneak in this type of language that end up hurting because a lot of developers are there to develop and then sell. So
Mhm.
end up hurting their ability to sell on the back end to other buyers if this type of language is in there because we're going to be looking for it. So it's definitely key to make sure that you look at the leases and it makes sense for you to take the risk or not take the risk.
So someone that's brand new to triple net lease, what are the things that you've seen, that go wrong right out of the box? Like when the wheels come off the bus, why do they come off the bus? And it does, obviously there's a million reasons, but what are you telling the new person that's trying to get in? These are instant red flags and you got to pay.
Yeah, with the red flags, will be buying deals that have older existing leases. So we've seen a deal where 7-Eleven, which is an S&P A credit tenant, one of the best in the industry, one of the most popular tenants that I sell, and they just fly off the shelves. But a lot of times, 7-Eleven to acquire more real estate and build their portfolio, they'll buy a bunch of older stores from like other gas station owners and then convert them over to 7-Elevens. But the sneaky thing is that some buyers don't notice is that they carry over the old lease and then kind of like, kind of update it a little bit. So if a buyer comes in and don't read maybe like 20, 30 years worth of lease amendments and all that stuff that they can find that they may be responsible for tenant improvements or they may have to do something to get the compliance with the state. It's just like, so it's really just making sure that you know what you're getting into. And then of course, every deal, you have to look at it from a real estate perspective. And then we also came across issues where I do a lot of new construction sales, but then you also have to look at, they're doing like out parcel deals. You want to make sure everything is clean there. So just like mainly the typical stuff you'll see, like any type of office or retail center type of deals that you want to make sure. But my main concern would be just buying deals that have older leases and just making sure that we know exactly what's in there. So when we do the transfer, that you're not responsible for changing out the oil tank or things like that that the tenant is saying that you need to do. So those are the big factors there.
No, that makes sense. And at the end of the day, I think the biggest thing to keep in mind here is that it is a real estate play, right? If you have a good piece of dirt, and this goes real estate, no matter what you're buying, right? If you buy the one-off that's in the middle of nowhere, you have to understand the risk that comes with that. When you're buying a triple net lease, I don't want to say you could look past some things that aren't great. If you have a great piece of dirt, you can fill, I don't care if you have a mom and pop restaurant or, a triple, an A credit rated tenant. A good piece of dirt is worth something. So if you're looking at it from that perspective, having a triple, an absolute triple net lease in there can't hurt, right? It's only going to benefit it. So understand that, when you buy a triple net lease, you're getting quote unquote guaranteed income, with corporate guarantees, so on and so forth. But, a good piece of dirt is a good piece of dirt. And that's something that you can't, it's irreplaceable. And that's probably the biggest factor when you're buying a triple net, the security of the income and the consistency and no ups and downs and vacancies when you have a long-term tenant. But when you get a good piece of dirt, you get a good piece of dirt, and that's sort of the security blanket there.
Exactly. Yeah. At the end of the day, it's all about real estate. So it's the same approach that you look at any type of deal is about the real estate. And just another thing as well that we always see is that it'll be during the due diligence stage is like, of course, dirty phase ones and dirty phase twos and all that stuff. But the good thing about these net lease deals is like, we're doing a O'Reilly's deal, a little bit older lease, but, relatively, not older building. And my client was like, oh, we got to make sure. But these major tenants like O'Reilly, 7-Elevens, they're not going to sign on to something that's going to be a dirty thing that's going to cause them liability, especially if they're responsible for more or some of the responsibilities of the property. So that's another good thing to feel about, that you're dealing with. You have to deal with good tenants. Of course, it's like a mom and pop thing where and then things can happen, but if you're dealing with a lot of these major corporations, for the most part, they cover their bases. And for 7-Eleven, for example, they're responsible for all of the state and federal mandates as far as like environmental and keeping up with paperwork and things like that. So at the end of the day, and they put you as the co-insured on the property as well. So if somebody slips or falls, of course the tenant is covered, but you're also covered as well. So you just want to make sure that just read through the lease with your attorney and just make sure everything looks clean and says what they say they're going to do to make sure that you're covered.
Yeah, that's important. We had my family had a triple net building in Jersey City, and Verizon was the tenant. And in their lease, they actually had to take care of any environmental problems because they basically parked their trucks there, and there was a small office component. But when they left, they cleaned up the environmental. That was all on their responsibility to make sure they left it in condition that could be either moved right in and or with no environmental problems. They were there for 30 plus years. It was Bell Atlantic before Verizon. So they actually, their lease was great. And that's an important part, especially with these things, because some of these triple nets, if they are, an O'Reilly's Auto Part, right? If there's oil changes or stuff like that, you want to make sure, you want to understand what the long-term ramification of something like that is, whether they're responsible or you are. You got to be aware of it so you know what to expect in the future.
Exactly. And Verizon actually really good tenant. I think they're S&P A- credit rated for their corporate, and then they also have like a sub kind of franchisee, one of the larger ones that also take care of their leases as well. But yeah, that's great.
Mm-hmm. So do you see any interesting strategies that people try to use to like juice up triple net returns? Like, one thing I thought about, which I don't know if people do, is find a mom and pop triple net lease with an expiring lease and then retrofit it for a higher credited tenant that they can sell at a lower cap rate in the future. Like, do you see any sort of unique strategies that people try to do outside of just, the mailbox money and developing that people will implement?
Yeah, I had a couple clients that were looking into like short-term deals. But I mean, if it's like a great location and you had like a good tenant, even if it was a mom and pop, and this is like high traffic area, hard corner, densely populated, most part, a lot of them not going to be giving that space up unless there is some factors that doesn't make sense. There was a deal I was working on. I always keep talking about 7-Eleven. It was in Illinois, and it was an area. Of course, Illinois is a high tax state, and even though it was an okay area, but the space was just a little too small for them for 7-Eleven. It was just a convenience store only. Normally, like I deal with the ones with the gas component as well, and it was too small. Plus, the taxes didn't make sense. So my clients bought it for $850K and decided just to split into and just put into like a dental office and like another tenant. And it made sense for that particular case. And then since 7-Eleven's been there for over 30 years, their rental rate was very low. So they was able to come in and just bring in these new tenants, a dentist office, which was also an essential tenant, and it was able to get a higher rent. So they was able to kind of boost their returns from a smaller deal in that case. But it's not as easy to find. Maybe you can find like some existing land and then find like a tenant. That's how a lot of my developers do it. So they're constantly hunting for land. So I would say it's probably more on the play of like just ground up development, or if it's just like a building that just wasn't looked upon very well, and then maybe you can go pitch it to a tenant. Been to many conferences where I met a lot of the development team directly for CVS, a lot of the franchise tenants, Chick-fil-A, Wendy's, Burger King, and they give you a sheet and say, this is exactly what we're looking for. We want this type of population. We want these type of traffic counts. If you can find something that fits that space, then we're going to move there, or we're going to highly consider it. So yeah, I mean, there's definitely a play there if you can find a deal like that. But I think maybe just like with anything, just finding some good piece of real estate, and if a good tenant to a real estate match makes sense, then definitely you got a good deal there.
And when somebody builds, a triple net space for like a fast food restaurant or a Walgreens or whatever, how specific is the building to those tenants? Is it like, hey, find a piece of land, go to a Chick-fil-A and say, hey, we want to put something here, and Chick-fil-A is like, hey, here's the blueprints for the building, go build it for us? And then doesn't that pose some sort of a risk that if, for some reason that maybe not a Chick-fil-A, but another, maybe it's a Dollar General, like you said, if they fail, well, if it's a specific building for that company, how difficult is that then to release up for somebody else?
Yeah, it depends on the factors. 'Cause a lot of times with the developers, they acquire the land, and either how they structure it through a ground lease or like a built to suit, they can, they're pretty much getting a commitment directly. But in the case of if the transaction fail where they just not able to move there, like Chick-fil-A's requirements is around 38 to 4,000 square feet that they need for their building, and they need about an acre of land.
Mm-hmm.
But you can also, if that happened to not work with them, McDonald's also fit that portfolio is 2,400 to about 3,800 square feet that they need. So if you're getting that criteria, big size building, it's going to fit a lot of different types of tenants.
Mm-hmm.
Because a lot of them, they also have a requirement for parking spaces. Like, Chick-fil-A is typically 30 parking spots that they require, and enough for their drive-through. But Wendy's also can vary as well, depending on what type of prototype that they're using at the time. So yeah, I mean, for the most part, it's you're dealing with retail most of the time. It's pretty, like I said, like what John was saying, like you got a good piece of dirt, you can kind of make some sense of it if you have like a good size acreage of land there. You can kind of mix it up with the different tenants. So that's why I was like saying what the plan B is. If for worst case scenario, this tenant leaves, you can throw Starbucks or McDonald's or depending on it. But of course, it factors with the type of market that you're looking at as well. So it's pretty flexible, I would say.
Mm-hmm. And then
there's a space by me. It's funny. It was Four Corners, major intersection, highly trafficked area, and it was a Walgreens, a diner, and an Entenmann's. Then the Walgreens is there forever, and then it went out of business one day. But they knocked down the Entenmann's, they knocked down the diner. Next thing you know, there was a Walgreens and a CVS. And whoever owned this property, I don't know what happened or what the negotiation was, but they lost it. It sat vacant for probably 4 or 5 years, and now it's a dialysis place. But it was an old Walgreens that was turned into that, and then they just repurposed the land across the street. And I would drive by it for years because I grew up here, and I was like, this would be such a good development site. It'd be such a good development site. And next thing you know, the Walgreens moved across the street, and then CVS put one across the street. So they're pretty reusable or interchangeable, in that realm, right? You're not going to turn a CVS into a McDonald's most likely because it's probably a much bigger floor plan for CVS. But, maybe CVS goes out and Walgreens comes in, or a Rite Aid comes in or something like that. So within the element, it's probably easier to move if it's not a build to suite where normally the company puts a financial commitment of some sort. So you're building it and you're getting paid by them as opposed to you're building and taking the gamble, which also can be done. But that's probably where, you can see, okay, Chick-fil-A says no, there's 10 other fast foods, vendors that'll step in.
Exactly, yeah, because if your mind, if you're developing, you're thinking of Chick-fil-A, you probably thought of like, yeah, maybe they need 50,000 population within 5 miles. That's a check off. They needed a decent amount of household income. It was $55,000 or $60,000 per year. That's a check off, and it got good traffic. And if Chick-fil-A end up saying no, you got definitely another tenant, maybe not the caliber of Chick-fil-A, but somebody would be able to come in and take it off based off of you run your numbers and if it's profitable for you. So yeah, there's definitely some options there.
And then there's also, as you're going through development, and correct me if I'm wrong, but as you're going through development, as a landlord and or developer, you may just give them, develop them 4 walls, right? A white box. And then give them some tenant allowance, right? So you might be charging $20 a square foot, and you give them $200,000 of tenant improvement, and then you're just going to build the walls. They're going to do their own build out, like a doctor, a dentist might say, I need X-ray machines, and it's going to cost me $300,000 to move in here. You give me 250 of it. I don't spend the 250 to build it out for a dentist because then I need a dentist. But you provide them with the walls and the location, and then they'll build it out themselves. That's probably, that happens all the time in the development.
Yeah. That's the majority of stuff I'm working. Like the last 7-Eleven deal I did in Texas, it was the same thing. They just provided the utilities, like everything on the ground, made sure like the the sidewalks, all that stuff, did the stuff for the city. And then 7-Eleven came in and completed their building, and that was pretty much it. And
Yep.
then if that takes off for the risk off of you, you know they're committed to the site, and you pretty much know that it's a done deal. Plus, they signed the lease, saying that they're going to go into the site. And but of course, you got to make sure that you do your requirements. But for the most part, yeah, that'll definitely check off all the boxes, make sure that you're in it, and that you're going to be this deal is going to make sense for you and work out.
Yeah, no, 100%. A buddy of mine just built a triple net in Charlotte. I'll actually make an introduction because he was thinking about selling it. So I'll make an introduction offline because he's been toying with it because it just far and away exceeded all expectations as far as build cost and valuation. I mean, he never thought he was going to get the value he did. So he's been looking for either a value of it or what. And it's a dentist. There's like 3 or 4 spaces in there, but it's all absolute triple net. But yeah, that's exactly what he did. He basically put up the walls and gave the dentist the allowance and said, okay, go in there and put your, you build it out, and I'll give you 6 months free rent or whatever, or whatever it was.
Exactly.
So
Yeah,
when
it's
you
just
have
a lot of opportunity. It's surprising, like I said, with dentists and other different tenants, they just been doing well. I don't know how long that's going to go. Of course, interest rates rise and all that stuff, but on the net lease side, we was always on a good footing. So it was, nothing was overbuilt. People wasn't taking high LTV. The banks were more disciplined. So overall, the market has just been prime and good, and it's been continuously this amount of needs that people are looking for. Of course, people are concerned about what's going to be happening with exchanges and stuff. If there's anything, everybody going to tweak with that stuff. So I get a lot of calls concerning about that. I want to get this done before something happens. We don't know, but for the most part, people recognize essential tenants for specific tenants, essential needs tenants, and absolute triple net and cash flow and safety and security and long-term leases. Those kind of outweigh a lot of the things that they was thinking about, and that's what seems to be more important to them rather than maybe a higher return investment, or just diversifying like you guys have.
Mm-hmm. So when people buy deals, do they have to have we're talking about $200,000-$300,000 maybe to build out a space? When I know people oftentimes don't like it when leases are expiring, probably for that reason. When people are buying these deals with expiring leases, will they come with larger capital reserves in case a tenant does move out for these tenant improvements to release it up, or how does that typically work?
Yeah, I would say so. Bringing back to that same 7-Eleven example, they had asked for about $200K in tenant improvements, and that was for changing out and removing a old oil tank so they can be compliant, and also some stuff to kind of rebuild their store. And then for there, they said we'll give you a 15-year lease. That was the pitch that they gave us. There was some other stuff that was ugly with the deal. That's why we had backed out of that one. But yeah, I would say that having that, because you never know if there's going to be a lot of stuff, especially if it's like a gas or some type of auto tenant that's going to require you to get a clean clean phase 2. So it's just that factor, and if there's any new prototype, but it depends on the tenant as well, because like John was saying, if you just build up certain walls, give it certain maybe rental credit allowance, that they're going to take over most of that there. But as far as the developer side, just being conservative with the numbers to make sure that you're coming in okay, to make sure that the deal gets done.
Mm-hmm. Awesome.
Also, some of the lenders in this space, and you would know better than me, sometimes lenders, when they give you a loan on it, they'll hold back money that's released as you hit milestones with lease ups, where your lender will sort of, I don't want to be your fail-safe, but they know you're going to build out a dentist office, for instance. The lender that's underwriting that knows, an average dentist spends $250,000. They may say, okay, we got to hold this back, right? We're going to keep this. So then when the dentist comes in, it's future funded or something like that. So the lender can also probably, I don't want to say save your ass, but they can probably, they know when they write the loan, they know, the average 7-Eleven is going to cost $250 to build out, or they have ballpark ideas. So they can help you there, or at least it's questions that if you're looking at it, or if you're the owner of something, you either have to reserve for it for the future, or, you have to make sure that you're prepared for that or understand it. So you got to use help wherever you can.
Exactly. Yeah. The lenders definitely, they got so much data on it. It's kind of like, Fannie and Freddie, they know like everything about every single market and what this is and all the different stuff. So they, make sure as, developer coming in, you have to run your numbers and of course your contingency numbers and all that stuff. But for the most part, if you're dealing with a lender, very experienced on that side, they definitely can, like I said, save your ass on certain instances there too.
Mhm.
And then also from a landlord perspective, let's just say I have it doesn't matter. Let's say I have a Wendy's, right? And they close or they go out of business or they leave. If I, as a landlord, if I knew someone wants to come in there and take my space, as a landlord, I may say, okay, I'll give you 3 months rent, or 4 months rent or 6 months rent, but build out the space yourself. If the tenant is willing to build out their own space triple net, they're going to put a financial commitment into that. So they might not pay me for 6 months or 3 months or whatever I negotiate. But if the tenant comes in and spends 60 grand or 80 grand on let's say it's turning a Wendy's into a bar, right? They might come in and revamp the whole thing. If they're going to put the financial capital into it, well, then they built it for me. I don't get rent, but if they fail, I got a free bar, right? Now it's the same thing. I either have to spend the money and tailor it towards a specific tenant, or my commitment at the landlord, I don't want to spend the money. Market rent's $20 a foot. I'll charge $15 a foot and give 5 months, right? Or 3. And then someone could say, oh, look, my rent's going to be cheap. I'll negotiate a 10-year lease and I'll put the money into it because, I'm going to save money by building it out myself and having a landlord do it. So it goes both ways. As a landlord, either you reserve for it and you build it out for the tenant, or as a landlord, you say, okay, well, I'll credit you and build it out yourself, see how committed you are to the space.
Exactly. Yeah, they got some skin in the game that definitely makes you feel a lot better. Taking that risk or negotiating it which way. Rich, like I said, a lot of these net lease deals are structured that way anyway. So.
100%. All right, I think that's a great place to wrap up. Dwaine, thank you so much for coming on and sharing your knowledge and insights. If people want to learn more about you, connect with you, follow you, where can they do all that stuff?
Oh, you can pretty much find me anywhere on social media, LinkedIn. People's interested in learning about just having a discussion about net lease, how we are at the market. Take a look at deals or whatever. I can be able to walk you through that. I have a website called buynnnproperties.com. Just fill out a form and then we can just get on the phone and kind of chat about your needs, or just chat and see what's going on in the market and see if it's actually a good fit. So I appreciate you guys having me on.
Yeah, for sure. Guys, definitely go hit him up. Go check him out on LinkedIn, Dwaine Clarke, and check out the website as well. But thank you everybody so much for listening to this episode of the podcast. If you are not already subscribed, it would mean the world to John and I if you would do so. But if you are, please send it to someone that would get a tremendous amount of value from this episode. And Dwaine, thank you once again for coming on, bud. This was great.
All right. Thank you, brothers. Take care. Have a good one.